Home price to income ratios reached 7.14 in early 2025. This ratio measures exactly how many years of total household salary it takes to buy a house in cash. This record-breaking figure means that housing costs are currently rising 6 times faster than your paycheck. Why does a typical family home now cost 8 times the average annual salary when just 40 years ago that same dream was accessible for only 3 times a family income? We are witnessing a permanent shift in how the economy functions for everyone. Notice how this price-to-income ratio of 7.14 compares to the 3.5 ratio in 1985. The 30-year fixed mortgage rate surged to nearly 7% in a historic sprint that fundamentally changed the cost of living. This interest percentage represents a doubling of the monthly payment for the average family compared to the 3% era. Currently, the median sales price of houses in the United States has reached $420,800, which creates a mathematical wall for the typical worker. For a person earning the median income of $83,730, this price point of $420,800 is out of reach. When the price of borrowing moves this fast, it freezes the purchasing power of a generation. Many assume that if they just work harder, the math will favor them, but the reality is that the cost of money has moved significantly faster than the ability to earn it. Today, the annual household income needed to afford a median home of $420,800 is at least $100,000. This creates a rigid barrier where only the highest earners can participate in the market. Once you grasp this income requirement of $100,000, you will start to look at housing headlines in a new light. Why is it that even with these high interest rates, prices are not falling as they have? The housing supply shortage reached 3.7 million units by late 2024, creating a vacuum that keeps prices high regardless of demand. Experts at Freddie Mac suggest that the market is at least 1.5 million units away from being a balanced environment. This shortage of 3.7 million units did not happen overnight. It is the result of a long-term policy shift that slowed down residential development after 2008. When you have a deficit of 3.7 million homes, every single available property becomes a bidding war battlefield. Most observers think that higher interest rates should force prices down, but the market is defying logic. We are missing 3.7 million homes across the nation. For anyone trying to understand why a modest starter home feels like a luxury, this supply deficit is the primary culprit. Building more houses is essential, but it will take years to bridge that 3.7 million unit gap. The most startling disconnect is the gap between what you earn and what a roof costs. Nominal home prices surged 415% since 1985, while nominal wage growth was only 255%. In plain terms, the price of a home moves at a sprint while your income is walking at a slow crawl. If we look at real wage growth after inflation, it was only 12% over the last 20 years. During that same window, real home price growth hit 75%. This is why people feel like the economy is working against them, despite the 4.0% unemployment rate. The ladder to the middle class is being extended further away as the housing market stays at a price-to-income ratio of 7.14. This 75% growth in home prices compared to 12% wage growth represents a systemic decoupling of labor value. You might have heard corporations are buying every house in sight. The institutional investor share of ownership for single-family homes is actually only 0.55% of the total housing stock. While the focus is on financial giants, the real pressure comes from smaller sources. The overall investor share of sales reached 33% in 2025, driven by individuals looking for rental income. These smaller landlords account for over 60% of investor activity. This creates a paradox where your neighbor outbids you for a home. The competition is against smaller buyers who represent 33% of all sales. For a family earning $83,730, competing with investors for a home is a struggle. For those forced to wait, the rental market offers no sanctuary. Inflation-adjusted rent levels are now 20% higher than their 2000 levels. The portion of affordable listings for incomes under $50,000 fell to 21.2% recently. Compare that to 48.8% in 2019. This drop from 48.8% to 21.2% happened in just 5 years, pricing out half the workforce. Current homeowners are sitting on mortgage rates of 2 to 4%. These owners have no incentive to move and take on a 7% loan. Until the supply gap of 3.7 million units is closed, the price-to-income ratio will stay at 7.14. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath, the incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything. Into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives, and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that. Noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.